Okay, yeah, hello again. So yeah, in this talk we're trying to look at a little bit about the history of Bitcoin trading and trying to have a vision for the future, or where we can realistically get with the technology that we already have available. So first of all, a little bit of a recap of the early history of Bitcoin. Yeah, Bitcoin, as we know, started in January 2009 with the Genesis block, and actually not many people remember it, but the actually first place where you could trade Bitcoin was bitcoinmarket.com. That yeah no longer exists, but yeah, it was takes the title for the very first exchange where you could start to buy and sell Bitcoin back in 2010. Then a few months later, the more famous, or infamous, I should say, empty Gox starting operation, and yeah, from there we had yeah, gradually really significant growth of the trading activities on top of Bitcoin, of people buying and selling Bitcoin, with other exchanging following, like yeah, Bitstamp Kraken, BTC, that is no longer there, but has been. It was, I think, like the first exchange also to start listing altcoins, and then a bit later also us on Bitfinex we started operation, and then all the others that came later. And then I think a quite important point for the history of Bitcoin trading was the collapse of empty Gox, because at the time empty Gox had the vast majority of trading volumes happening there. So after that, the market became much more decentralized and I would say distributed across multiple players. But all of this is only about the spot trading, and spot trading it's okay, but it's really not enough for a lot of reasons. Like what the market really need is also access to derivatives trading. Why this? Because I mean, derivatives really help you to move risk between like risk-adverse players towards risk-tolerant players in a much more efficient way. They help with the price discovery, and they really need for sophisticated investors to precisely adjust their exposure to Bitcoin, because I mean, without derivatives, you can only express your vision of the future Bitcoin price according to the capitals that you have available to buy Bitcoin or to sell Bitcoin. With derivatives, you can do it in a much more precise ways, using either leverage or options and all kind of tools that you have available. And this, as a byproduct, improve also market liquidity. So when did we start having derivative tradings in Bitcoin? Well, not many people may remember it, not many people may know about it, but actually already in 2011 we had the first experiment of derivatives trading on Bitcoin. This was yeah, nothing professional, I would say. It was just some people on Bitcoin Talk, a guy on Bitcoin Talk, that basically starting to become like the maker for people that wanted to bet on the price on the future price of Bitcoin. So it was yeah, it was a very not very efficient system. So the way you would express the price that you expect Bitcoin to get at a specific date would have been by sending a Bitcoin transaction and using the decimal part of your Bitcoin transaction to say what is going to be your bet. So if you believe that Bitcoin is going to be worth $13 on the 1st of July, you had to send whatever you wanted to bet. So in this case, 1 Bitcoin, and then 0.13. So this was the way to express your bet, which it was like, yeah, I guess it was very interesting experiment, but of course not something that could work at scale. So then, yeah, later on we started to have real derivatives on top of Bitcoin, with the first perpetual listing actually happening with BitMEX from Hong Kong. Then we had the CME futures. Then we started having the physically settled futures, the future-based ETF. And then, I mean, it's not derivatives, but it's quite important moment also was last year with the spot ETF. Then also was a catalyst for all the derivatives on top of the spot ETF. So this was, I mean, we had quite a journey to get the industry mature enough in the past 15 years, going from like bets on a Bitcoin Talk forum, using on-chain data to define like the way you wanted to bet on the Bitcoin price. So basically, creating a future long or short position using this rudimentary method to have all kind of products on top of Bitcoin, option, futures, both directly on Bitcoin or on ETF on Bitcoin, cash settled, physically settled. I mean, this is a much more mature industry, and yeah, I mean, this also is what enables now to have this much more efficient market where the price discovery it works better, and also, I mean, compared to the early days, we have lower volatility level. I mean, people complain that Bitcoin is still volatile, but compared to the early days, definitely the market structure improved a lot in this regard. But then, like, what we saw so far was only about centralized exchanges. But actually, a very important part of the development of these industries is also the decentralized trading, because I mean, Bitcoin was created around the premises that we can have a decentralized system to exchange value. But then, if for the trading part can only happen on a centralized platform, that's kind of it's not ideal for people that do not want to rely on trusted third parties. So we have two main kind of decentralized DEXes, decentralized exchanges. The first experiments were using the order book based DEXes. Actually, the first experiments were directly on top of Bitcoin, using a layer 2 protocol called Counterparty back in 2014, 2015. And the idea is that like you use on-chain data to place a limit order. You send a Bitcoin transaction, or like or a Ethereum transaction later on, or whatever other chain transaction. And in the transaction data, you basically express at which price you are willing to buy and sell. And when there are two transactions that express complementary orders, then a matching can be executed, so the trade can actually happen between the two parties that express the willingness to trade at the same price. But this has problems. I mean, order books are the best way to do price discovery, but to do it on chain is very inefficient, because any order, even orders that you may want to cancel quickly because the price change, needs to be an on-chain transaction with the cost related to it, and also with the latency related to it, because the order will actually get on the blockchain only when the next block comes. So this is a massive latency that for most traders is not very acceptable. And but yeah, the bigger problem is very, very expensive, because even in chains that are not as expensive as Bitcoin, still to have to pay an on-chain fee every time just you want to place an order, not make a trade, just place an order. It's a bit too much generally, especially if you don't trade with huge sizes. And then to address this problem, the automated market makers came in, that are a way to have like more efficient trading, because instead of having everyone to place order, basically there is this pool of liquidity, and the pool can understand what is the fair price of the assets involved based on the demand coming from both sides of the market, and in this way you can always do market orders against the pool and get the order executed with only one on-chain event. But this is very suboptimal for price discovery. You will always get not amazing pricing, because first of all, it's basically only market orders. The pricing of the asset may not be will not be perfect, because the algorithm that defines the asset of the price it needs to be very simple, because otherwise in the case of Ethereum it will consume too much gas fee, so it will be too expensive to execute. Then there is the problem of, you still have the problem of latency because everything is happening on chain, so you need to wait for block confirmations for things to happen. And there is big risk of market of manipulation, especially against also individual users, because you are posting your desire to execute an order for a certain size, to all the world, because you publish it on chain, and people can use this information against you. They can see that you are about to buy a certain amount of Bitcoin, so they will use this. They can use this information against you to front run you or to manipulate the price before your trade is actually executed by paying more fees than you, or if you are a miner, by manipulating the order of transaction in the block. So people use AMM because it's the best option we have right now in terms of cost to do decentralized trading on chain, but it's really not ideal. I mean, it's really not ideal, and the pricing that you get is really not as good as you get on a normal order book centralized exchange. I mean, not even close. What is the solution for this? As we were mentioning before in the panel, Lightning can really drastically improve on this. Why? Because on Lightning we can use atomic swaps, so that atomic swap enables to have trades between two parties without needing to trust each other, thanks to the atomicity provided by the Lightning protocol. We can have atomic swap between Bitcoin and other tokenized assets, this is possible thanks to this new tokenization protocols on top of Bitcoin, such as RGB and Taproot Asset, that enable to have other assets on top of Lightning that is not just Bitcoin. So in this way, we can have on top of Lightning directly swaps between Bitcoin and USDT or whichever other assets people are interested in trading. And this has several advantages. First of all, it's fast. It's fast because you don't need to wait for on-chain confirmation. Everything happens off-chain, so it happens at the speed of a Lightning payment. That, of course, the speed of the Lightning payments depends a bit on how well you are connected to your counterparty. But if you have a direct connection, it can be like almost instant. Then it's private. This is actually maybe the most important part, because no one can see your trades. Only you and your counterparty will know that your trade even exists. And so in this way, nobody can use the information against you, and nobody can front run you. So this really helps for the protection of the traders. And then there is the efficiency, because you don't need to use some very simple pricing algorithm, because you don't need to worry about gas fees. You can use the party can use whichever like price discovery mechanism that they want. They can use some sort of order book based price discovery or RFQ, whatever they prefer, but they are not limited by expensive computation. They can use whatever pricing algorithm they want to actually place their limit orders or on the network. But this is only spot. All of this only enable spot trading, which is great, but it's not enough. If you want to play with this, there is a startup that already launched a first MVP of their product called Kaleidoscope, kaleidoscope.com. You can try it and play a little bit with trading on top of Lightning. They use RGB for the asset tokenization part. But then, if we want to move to derivatives trading, which is actually quite important to have the derivative trading, which is also decentralized, then we need more components. Because of course you can have derivative tradings on EVM chain, but you end up with the same problems that we saw before. Everything is on chain. It can be quite expensive. You can be front run. It's a chain that doesn't have the same security guarantees of Bitcoin. But on Bitcoin, if we put together three different technologies, so we have Lightning to have fast and cheap settlement. Then we have tokenizations like RGB of Taproot Asset to have the possibility to do settlement in stablecoin instead of Bitcoin. And then we have advanced smart contract. They're called DLC smart contract that enable to settle a contract based on the outcome of an oracle that will tell you what is will sign the correct price of Bitcoin at the moment of settlement. So putting these three technologies together, we will have the possibility to have derivative tradings happening on Bitcoin at scales. Now, these three technologies, they all already exist, but there still needs to be some effort to put all of them together and to create a decentralized derivative market. So we don't need any software, we don't need any new tech to make it happen. It's just a matter of building and putting pieces together. And yeah, hopefully in the coming years we will have like amazing decentralized derivative trading directly on top of Bitcoin without trust compromise. Okay, that was it. So thank you for the attention.